Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of our Monday market updates coming to you 9 a.m. every Monday morning. Get you ready for the week, what stocks to watch, all the economic news that might guide the markets, and just really to connect with you out there in the Bowtie Nation. A lot of great citizens of the Bowtie Nation out there already in the chat talking with you. Melanie, Ambrose, Craig from the UK. Great to see all you citizens out there wherever you're coming to from the world. I want to get started though because with the market so crazy volatile lately, up 3% last week, even despite last Friday's big sell-off. Looks like today is going to be down again today as we give back some of that rally. There are still opportunities in the markets. Now the stocks never give you a sure thing, but sometimes it gets pretty close. Case in point, today's topic that we're going to talk about, 102% upside potential return within a month on kind of a special situation with APE and AMC that we're going to talk about. So I'm going to talk about that. Going to talk about the stock market update this week, the stocks I'm watching, the economic news to follow, as well as get to your questions and answers. My favorite part of the live stream, as always, just really connecting with you out there in the community. But before we get started, I do want to highlight a link I've left in the chat there. It's of the free report I set up with the Motley Fool, the 5 best stocks the 7 stocks that I'm investing in, kind of my forever stocks. Check that out. Click through the link. It's a free report, totally no obligation. Motley Fool is going to send you some emails trying to get you to sign up for their premium access. I use it, the advisor program, just to kind of get some free or some advisory and some research. But there's totally no obligation. Click through, get the free report, see some of the biggest stocks in my portfolio, and you'll be helping to support the channel. So I appreciate that. But let's move on to the main topic because like I said, the market never gives you a sure thing out there, but sometimes it presents opportunities that are about as close as you get. And one of those is coming up right now, something we've actually talked about here in January, about a month ago. We're seeing something like that in the planned conversion of AMC preferred shares, and we're going to fight with the mower here for about 5 minutes, but then they'll be done. The conversion of the AMC preferred shares, the APE shares, into common shares of AMC, okay? Now, if you don't know what happened, back in August of last year, AMC Entertainment, okay, so ticker AMC, created some preferred shares, sold preferred shares out into the market with the intent. These were always intended to be a one-for-one conversion back into common shares, okay? They issued these preferred shares to raise cash, keep the company out of bankruptcy because it has been touch and go ever since, and before that, and since the pandemic. But then the idea was to convert these preferred shares, because that's how preferred shares are. They give you some special rights as a shareholder. You get dividends before any other shareholders, that kind of thing. But then the intent is that at a certain price point, they can convert into common shares. Well, the intent on these was just to ask for shareholder approval to convert these into common shares. So it's never really made a whole lot of sense. And I'm going to share my screen here, and we'll see it's never made a whole lot of sense why these APE shares trade for so much of a discount with the common shares. Okay, so you see here in the pre-market, shares of APE are trading for about $3.09, up huge over the last month. But then shares of AMC trade for $6.37 here in the pre-market, up almost 5% in the pre-market there. And you can see those are up quite a bit as well in the over the last month. But what I pointed out in a video early January is, again, that intent has always been to convert those APE shares into common shares of AMC. So they should be trading much closer to parity. That hasn't been the case. When I pointed that out in early January, then the APE shares were actually closer to about $1.60. They're up now 120% since that period. AMC shares are up about 58%. So just from what we talked about in early January, those APE shares are up really about 60% beyond what the shares of AMC are. So it's already a very good run since then. But if you just look at what they've got left to do now, AMC, so management of AMC is now asking for shareholder approval to convert those APE shares into common shares. So basically, if you own shares of the preferred shares, the APE, you're going to get 1 share of AMC for every share of APE that you own, right, upon shareholder approval. So what does that mean? Obviously, if you buy a share of APE for $3.12, and then you're going to get a share of AMC for $6.37, that's a pretty good deal. And it's actually almost 102% return. It's so $6.37. We can do this. See if my calculator will come up. There it is. So right now, if you're getting $6.37 in a share of AMC divided by the $3.02, you're getting 110% return on the conversion of those shares. Now, there is risks here, and that's what I want to talk about. I want to talk about how some institutional investors, some hedge funds are playing this, and how different ways to do that. Now, so again, there are risks. The one risk is that the price of these AMC shares, the $6.30 shares here for AMC, the common shares, could fall down to the APE shares before the conversion. Okay, that is always a possibility. This stock has been touch and go with bankruptcy and watching the balance sheet there. But there is nothing to say that these shares of APE share or AMC shares couldn't come down to APE, the price of the APE shares before that conversion. That would likely wipe out a lot of the return for APE investors, but it wouldn't wipe it out completely. I doubt that these AMC shares are going to fall all the way down to that $3 per share by the time they convert. Another risk is that they just can't convert, that they don't get shareholder approval. They do have to get shareholder approval for this conversion. I don't see that as likely that they don't get any kind of approval for this, because that was always the intent. The intent was to issue these APE shares to raise cash, but then to convert them into common shares of AMC. So that's probably not likely to happen. It's a little less likely. Now, as I mentioned in January, when we first talked about this, early January, the smartest way to play this is to buy the shares of APE, okay, buy the preferred shares, ticker APE, and short while shorting on a one-for-one basis of those shares of AMC, right? Okay, so that gives you the upside of the APE shares and then protects you from any downside on your shares of AMC, okay? Okay, so again, if you would have done this in January, you would have gotten that 120% return off the shares of APE. You would have lost the 58% that the shares of AMC went up, so you would have collected the difference, right? It's called an arbitrage situation. This is what a lot of the institutional investors, a lot of the hedge funds are doing, is they're buying shares of APE, they're shorting shares of AMC to remove that risk. It's not necessarily like you hear about short sellers, you hear about people shorting stock, about just betting against the company. This isn't that. This isn't betting against AMC. This is just removing that risk. It's removing the risk that shares of AMC come down while betting on shares of the preferred shares, the APE. So that removes part of that risk. There is still a risk, obviously, if the shares are not converted and those shares of APE do come down, then obviously, you're going to be out that. If you're long shares of APE, those shares come down, you're going to be at a loss on that. In that instance, then you would probably also likely lose a little bit on your short of AMC, whether those go up or not. But it's just a way to play the risk. Another reason why a lot of the downside to that strategy of shorting shares of AMC to buy shares of APE is that the cost of borrowing those shares of AMC to sell short is extremely high right now. The volatility is just off the charts for this stock. It can go up 10, 20% in a single day, or down by just as much. So the cost of borrowing those shares from a broker is very high. And that's why a lot of the short interest is already well above 20% for the stock. That's why a lot of institutional investors, a lot of hedge funds are, maybe not doing a one-for-one buy short kind of position, but maybe they're buying 2 shares of APE and shorting just 1 share of AMC. So it doesn't remove completely that risk, in the AMC shares, but it does remove some of the risk and is a little bit more closer to that arbitrage situation. Now, if you're like me and you just don't like shorting stocks, okay, I don't like being on the short end of a stock. I like betting long, betting on the stock performance and growing with the stock price. Then you can just buy the APE shares as well. Okay, so you're buying shares of APE, that's the preferred shares of AMC. You're just going long on those. You're waiting for that conversion. Like I said, over the last month, shares of APE are already up 120%. If they get converted, they're up another 110%. On conversion to these shares of AMC. So you're up quite a bit just being long on that. Now you do still have the risk that shares of AMC are going to come down, or that those shares of APE are not converted into the common shares, or maybe it takes a little bit longer for them to be converted. So you do have those risks if you're only long on the shares of APE. But that's it's really great special situation that you can play. You get very few of these in the stock market, and you got to take advantage of them when you can and when they do come along. I now want to turn it over to our Monday market update. Some of the stocks I'm watching, some of the news to follow this week, as well as just getting to your questions and answers. Big week this week for earnings. We've got almost 100 companies in the S&P 500 reporting their earnings. That's about 1 in 5. 50% of companies already have reported their earnings. So far this earnings season, Q4 earnings coming out, stock earnings. So earnings of companies in the S&P 500 already down about 5.3% from last year. That is expected to continue into the first and second quarter. So we're really seeing some weakness in corporate earnings here this week. What I'm looking at first here is Simon Property Group, scheduled to report earnings today on Monday after the bell, after a strong rebound, about 44% up in this stock since the October lows. Company is expected to report about 11% growth in earnings to $1.70 a share on 4% revenue growth. So really interesting that they're able to turn that 4% revenue growth into 11% growth in earnings. It's kind of different from what we've heard with a lot of companies. Solid earnings from retailers should help the mall operator put kind of a positive spin on its earnings and support the shares. But really that longer term, and this is something we talked about on Friday with our this versus that Simon Property Group versus Realty Income video. This is something that I highlighted in the matchup there, that Simon Property Group, the SPG, is really losing its REIT focus by taking operational investments in a lot of bankrupt retailers like Forever 21, JCPenney's, a lot of these stores that looked that were going to file bankruptcy. SPG came in, gave them a cash infusion so they wouldn't go bankrupt and they wouldn't create vacancies in those malls owned by SPG. It was kind of a real quick decision during the pandemic that SPG made to take operational shares in these companies rather than fill those store vacancies. The problem is I see it, is now it's losing that focus by just doing what it does best, managing those malls, sending the cash flows from the malls onto investors. Now it's got to be a retailer too, and that is not a great situation to be in with the rise of e-commerce, right? E-commerce sales, online sales, are only about 15 to 20% of total retail sales in the U.S. right now, but are growing continuously every year, expected to hit about 25% within the next 5 years here. And it's just the slow death of the mall, right? If you've gone to some of your favorite malls, they just look like ghost towns over the past few years, and this was even before the pandemic. So it's a little perplexing why Simon Property Group would kind of double down on this mall, on this idea, and put itself at risk, right? Because I think it can keep their malls alive by finding new tenants for those vacancies, but now it has to also come under the pressure of actually managing those retailers. A lot of them just old brands with very little brand strength, like JCPenney, going bankrupt and really never being able to turn around that company. But now they're having to turn around those companies, and it's just a long-term loss for the stock, I think. Next here, Robinhood, ticker HOOD. It's going to report its earnings on Wednesday. I know a lot of people are going to be watching this stock. Expectations are for losses to actually narrow here to just 14 cents a share. So a loss of 14 cents a share from 49 cents a share the same quarter last year. That would be on 9.5% growth in revenue to almost $400 million. Analysts are expecting Robinhood to report a 2023 loss of 45 cents a share on 1.9 billion in revenue. That would be a 38% increase in sales from last year. Okay, so analysts right now expecting Robinhood to be able to increase its revenue by 38% over the last year. And, with the drop in investing by retail investors, it's just difficult to see how Robinhood gets to that 38% increase in sales. They're doing well. They are coming back, especially on that rebound in crypto. That could support some kind of a near-term rebound in activity. But it is just hard to see, especially some of the comparative valuations here. Shares of Robinhood right now are trading for about 7 times on a price to sales valuation. Okay, so you're paying $7 for every dollar of sales reported by the company. That's more than 3 times the 2 times price to sales valuation for shares of something like a competitor, Interactive Brokers. Okay, IBKR, another stock investing platform. Obviously there's stronger growth and investor engagement on Robinhood. I think Robinhood is much more popular, especially with retail investors, than Interactive Brokers. But it is hard to justify that threefold valuation, right? 7 times on a price to sales valuation. That is well into growth stock territory, and it's just hard to see how Robinhood continues that pace of growth and even makes that 38% expectation for sales growth this year to justify that price to sales. So, near term, Robinhood probably looks like it's going to be continue that rally, but a little bit longer term, I would be worried about that price to sales and that valuation there. Next, PayPal is also going to report its earnings on Thursday. Expectations of $1.20 a share here. That would be an increase of 8% from the last year on about a 6.8% revenue growth. Full year earnings here are expected 16% higher. So expecting a rebound in PayPal. One thing that I like about PayPal is that it's coming off those really hard comparisons during its eBay period, right? So if you don't know about before up to about a year ago, then you could use PayPal as a kind of a default payment processor on eBay, right? eBay dropped that a little over a year ago, started using a different payment processor. And so it made those comparables very difficult for PayPal, right? A lot of the sales and the revenue growth came off of PayPal because it had to, every quarter, it was comparing that quarter's revenue growth, that quarter's earnings against periods when they had that opportunity to pay on eBay, right? Well, that's come off of the stock right now. Now, what we see each quarter is not the comparison a year ago with eBay, but a comparison post eBay, after eBay. So those comparisons just look much better. And I think that's where you get this 16% increase in earnings expectations here, for this year. 9% revenue growth expected this year to $30 billion. Another positive, I think, for PayPal right here, especially for this earnings when it reports on Thursday, is the earnings surprises from SoFi and Upstart. Okay, two other, SoFi and Upstart, much more kind of lending platforms. SoFi, one of my favorite stocks, one of my largest holdings actually in my own portfolio. More of a fintech, complete online banking. Upstart, much more of just a lending platform. But both of these companies reported some very strong demand in personal loans lately. Okay, it seems a lot of people, working through their pandemic savings and turning to credit cards, turning to personal loans to keep on spending without maybe having to work quite so much. But anyway, SoFi and Upstart reporting very strong demand for personal loans. If you look at both those stocks over the last couple of weeks, when they reported those earnings, a big boost on those shares because of that upside demand in personal loans. I think that could hit PayPal as well. PayPal could get the benefit by reporting higher demand for personal loans when it reports here on Thursday. Shares are up about 10% since highlighting it as one of my forever stocks in January, and it continues to be just a very good long-term holding for me. Next stock I'm watching here, WP Carey. It's going to report its earnings on Friday. This is one of my favorite diversified real estate owners. Most real estate investment trusts or REITs they focus very much specifically on one property type, right? Which, if you're buying that stock, then it leaves you exposed to what might happen in that property type if something, in the news or in the larger macroeconomic situation kind of comes against that property type, like office did in the pandemic. With WP Carey, though, you get much more diversified real estate exposure. Okay, they own a lot of those different property types, including industrial, office, retail, and it really spreads out your risk. So this is one reason why I highlighted WP Carry is really my favorite one dividend REIT. If you're just buying one dividend REIT, one dividend real estate investment trust, then you would make it this one because it's going to give you that exposure to many property types rather than just one that you get with most real estate investment trusts. Looking at the sectors from last week, give us a kind of a big picture idea of what sectors of the economy are growing. We're here at sectorspider.com, one of my favorite tools here, this sector tracker. You can go here, go to sector tracker, and you got different time periods here that you can look at, how those sectors did. We're in the 5-day period. So last week, 8 of the 11 stock sectors did close higher last week. Stock market overall up about 3% last week, with stocks in the energy sector really falling hard on a drop in price in crude. Crude prices were down about 7.5% last week to about $73. Looks like they're up a little bit in the pre-market today, but just that lower oil price versus what oil companies were collecting in the first 6 months of the year, I think could make it for difficult earnings comparisons when the companies start reporting their first and second quarter earnings. Okay, so if you remember last year in February, actually I think it was real close to now, then Russia did formally invade Ukraine, sent the price of crude globally up to $100 a barrel, almost hit $120 a barrel a couple of months later. But really, all through the first 6 months of last year, crude prices were well above where they are at right now. So what I think you're going to start seeing, and we've already started seeing a little bit there with Exxon, with Chevron last week reporting, but what you're going to start seeing is you're going to start seeing these energy companies, these oil companies start talking about that, how their first and second quarter revenue is going to be lower versus last year just because of that lower price of crude. So they're going to start talking about a little bit more cash management, cash discipline, not growing those dividends quite as much as they did last year, and I think that's going to weigh on the stocks, and so that's something that we saw last week with the big drop in energy stocks, despite still being very good cash machines, right? Exxon upped its share buyback. I think Chevron did as well. Both reported record high profits on the continued strength in oil prices, and these companies, after they give back some of last year's gains, just on those lower earnings compared to last year, I think these are still very good companies. I've actually got 2 long futures contracts in oil right now. I put them on just last night. Oil has very strong support right around $70 to $72 a barrel, because that's at the point where the U.S. government has promised to start buying barrels to refill that strategic petroleum reserve. Okay, so most of last year, the U.S. took up to about 400 million barrels out of the strategic petroleum reserve, that SPR, took about 400 million barrels out to supply the market with more oil, to bring down oil prices, to bring down gasoline prices. And now we are at a 40-year low in what we have in that strategic petroleum reserve, in that SPR. The U.S. government needs to start refilling that. They've promised to do that right around $70 to $72 a barrel. So I think, if the price of oil gets down to around that point, you've got very strong support for crude. So I'm investing directly in crude oil with the futures contracts. I think if we do get any more of a sell-off in energy stocks as crude comes down a little bit, then I think you can get back into those energy stocks and be fairly well confident that they're not going to go down too much lower. A lot of these energy stocks, especially the big producers like Exxon, like Chevron, their cost of production is right around $35 to $40 a barrel. So even as oil comes down to $70 a barrel, they are still very much cash flow positive, still very much going to be able to pay out those dividends and return that cash to shareholders. If we look at the longer term here, stocks over the year-to-date term here, the stocks in the hardest hit sectors are really the ones rebounding this year. Stocks and communication services are up 21%, so far this year. Consumer discretionary up 17%, technology up 14%, real estate up 11%. So really rebounding these stocks that were hit hardest over the last year. And while I believe a lot of these sectors have room to run, I like the stocks in the communication services sector. Those are going to be a lot of your social media stocks, your streaming stocks. You can see Warner Brothers up 62%, Meta Platforms, the whole Facebook, up 55% so far this year. I still like those stocks for the whole year. I think the sector, I think that pace of the rally isn't sustainable, and it's bound to run into reality as investors just realize the Fed is serious about holding its rates higher for longer. So, I've sold call options against some of my stocks especially in these sectors that have already gone up, so much. Communication services up 21% so far year to date. So I have sold some covered call options on those just to take some of the risk out and protect myself a little bit on the downside for those. I want to get to a question and answer now. We do have a busy week this week for the stock market. No real economic news to talk about. The University of Michigan's Consumer Sentiment Survey comes up on Friday. I've always kind of ignored it though because I think consumers say one thing and do the other, so it's not really a whole lot of weight to it. We will see inflation expectations for consumers in that survey. Might kind of move the market one way or the other a little bit, but not usually a big deal, that survey. Some other minor news, but nothing as important as the earnings that we'll see this week. And we can talk about this as well, what the market is expecting as far as earnings. Again, stocks in the S&P 500, about 50% of them, about half of them have reported so far, have reported an average of 5.3% decline in earnings versus the same quarter last year. So we are seeing stocks, companies report less earnings than they made last year. That's expected to continue through the first 2 quarters. So the first 6 months of 2023, we are expecting companies to report back-to-back declines in their profits. That is going to weigh on stocks, but we do have the upside to that. The jobs market is still very strong. The economy is still growing on a quarter-by-quarter basis. So we'll see how that plays out. 100 stocks reporting earnings in the S&P 500 this week, as well as a lot of other stocks outside of those indexes. So very important earnings this week. But I want to get to your questions because this is my favorite part of the live stream here, being able to answer your questions and connect with you out in the Bowtie Nation. So I'm going to scroll up here to see what questions we have. If you've got a question, go ahead and ask it in the chat there. Make sure you use a question mark so I can see that it is a question. And if I don't see it, then I'll try to see it again. We did have Craig from Craig's Outdoor Adventures there in the UK. Welcome. Thank you for joining us there on an afternoon in the UK. Asking what the kind of a dividend stock that you would go with if you had maybe a 500 pound spare per month. What dividend would you invest in? I wouldn't go with just one dividend stock. I know we have talked about my favorite dividend stocks. That WPC, the WP Carry, is a favorite of mine as far as dividend REITs. I think that's a very good one. I also like, some of the other dividend stocks that we've covered on the channel. MPW, Medical Properties Trust, is also a REIT that I really like. Has been hit hard over the last year. Just on one real estate investment trust, just sold off over the last year, just because of those higher rates, right? Real estate very highly leveraged, so anytime interest rates rise, that is a cost of doing business for these REITs, and it gets very much more expensive to hold that real estate and to pay those loans. So all real estate sold off last year. Medical properties, not just Medical Properties Trust, but the whole medical properties and healthcare REIT space sold off even more, just because the payments by insurers, health insurance, the payments by the Medicare and by the government haven't kept up with inflation, right? So we're seeing real weakness, income weakness with the healthcare providers, with the hospitals, and of course that's flowing through to the property owners that they have to pay those leases. I still like Medical Properties Trust. A lot of those healthcare property owners, they own the real estate. Nothing more valuable than the real estate on which these hospitals are. Even if one or two of those tenants bankrupt, they're not much more than 2 or 3% of the total tenants of the total leases held by these medical properties, property REITs. So you really don't see a whole lot of difference in these. So it's a great long-term or long-term theme, long-term property type to be in. Very strong dividend yield. So I like that one as well. We've covered a lot of dividend stocks on the channel, though. Look back on some of the videos we've done lately on those for some of those other names there. What are you coming in? Okay, what else do we got here? Jay done well with forward options. Not sure what stocks I should play. Options, thanks. Yeah, so Jay pointed out, SoFi up huge again. So, SoFi technology or SoFi ticker SOFI, great fintech company, one of my best, one of my largest holdings, and one of the best stocks, up like something like 70% over the past few weeks as that comes back out of that, out of last year. What else? Raul wants to know about Algonquin Power. Was your point of view? Really haven't covered Algonquin Power, so I'm not going to be able to give you much on that. Utilities have been hit hard, as you see here from the. If we look back on the sectors, year to date, utilities are down 3.6%. Far and above, the worst sector so far this year, underperforming the market. And what we see a lot of times is obviously one, these safety sectors, they just get hit when the rest of stocks rebound, right? People pull money out of those safety sectors to reinvest back in the riskier stocks, the growth stocks like communication services, like technology. So you're going to see an exodus of investors out of those utilities. But also utilities get hit when interest rates rise, right? With those high interest rates, because it is it is an opportunity cost for them. Those higher interest rates, investors start asking themselves, well, why am I investing in a dividend stock like a utility here when I can get an even safer investment in a bond or something like that is now paying those higher interest rates. So as interest rates rise, as they stay higher, you start to see a real weakness in the sentiment, the investor sentiment for things like consumer staples, things like utilities, those real safety dividend stocks there. What else do we have? Good morning. So great to see all you out there in the Bowtie Nation. Kevin there from Lakeland, Florida, actually real close to me. I'm here in Tampa, so real close to Lakeland there. Troy, good to see you there. Who else we got? Please look up Roger Jones Hamilton. Okay. SPD, so AMC will be around $4. No, it's basically what we're saying with the main topic that we talked about today with those APE shares and AMC. We're saying that the management is trying to convert those APE shares, ticker APE, the preferred shares for AMC, into common shares of AMC. So right now, ticker APE is trading right around $3 a share. They're going to convert that one for one into ticker AMC. So if you're buying shares of APE, if you're buying those APE shares, you're going to pay $3. You're going to get a share worth $6. Now, again, of course, the risk is that those shares of AMC do come down on that conversion. I don't think it's not going to come down and totally wipe out your return. So you might not get 110%. You might not get that $6 for the shares of AMC, but you are going to get a share of AMC, even if it comes down to $4 or $5. That is still that's still going to be a 33 or a 66% return on your money in probably about a month's time. So great opportunity there, I think, especially if you kind of hedge your risks there with the maybe with a short buy short strategy like we talked about. What else? This model very strong. Crush earnings. My bonds. Okay, Richard wants to know, Joseph, question about bonds. Is now a good time to start looking at longer-term 20-plus year bond funds? I'd like to lock in a good yield and hopefully get some good price appreciation. Yeah, I think especially with the historically bad year bonds had last year. Last year was one of the very few years in history where bonds lost their value at the same time that stocks did. Okay, that almost never happens, especially over the last 40 years. Then interest rates have continued to come down, and bonds have done very well, especially during those years when the stock market fell, and we saw interest rates bonds really saving investors. After that historically bad year last year for bonds, I think you can again start looking at bonds. There's really two ways really two ways you want to look at this. There's three ways, but we'll primarily talk about two ways. One is, so you've got different term bonds, right? You've got long-term and short-term bonds. The long-term bonds, you look at things like the BLV. That's going to be your Vanguard long-term bond fund. Now, this is a fund of corporate bonds, so bonds held by or sold by corporations. And they're all, 20, 30 year plus or 15 year plus bonds, right? So as you get bonds that are longer term, they're going to offer a higher yield, right? Investors demand a higher yield, a higher interest rate to lock their money up in a bond for longer terms, right? And even though, you can buy and sell this bond fund anytime you want. You don't have to hold it for 10 or 15 years, but those bonds held, they're longer term, so they're going to offer a higher yield. Right now, this long-term bond fund by Vanguard, the BLV, is offering a 4% yield, which is a pretty solid return, right? For corporate bonds, they have default rates of less than 1 or 2%. So very safe, very stable bonds, but they do tend to rise and fall more with interest rates, right? As interest rates rise, then bond prices come down because, of course, those old bonds offering those fixed interest rates, they're less competitive against new bonds or other interest rates that are now higher, right? So bond prices come down when interest rates rise. Now, the longer out you get on those, on those bonds, so the longer term bonds get hit harder when interest rates rise. That's why we saw the massive sell-off in long-term bonds over the last year, right? But that's one option, BLV. Now, what we're talking about here, what Richard is kind of talking about is, since interest rates are really approaching their peak, right? We're expecting just one more interest rate or one more rate hike by the Fed, probably about 0.25% next time when they meet in March. Maybe another one interest rate hike, maybe another 0.25% after that, but unlikely. Really, we're expecting just one more interest rate hike by the Fed. A lot of the other central banks around the world are coming up on their last of their interest rate hikes. So, if interest rates do have peaked out and will eventually, fall as the central banks and as the Fed bring their rates down, in a recession or as inflation levels out, then these long-term bonds are going to do very well, right? Because you are going to get some price appreciation. You're going to continue to get that 4% yield on this fund, and you're going to do pretty well. Now, if you are still a little bit worried about interest rates, then you can go with something like the short-term bond fund, right? The ticker BSV. That's a Vanguard short-term index bond fund. Kind of same idea. They're holding thousands of bonds here. Short-term corporate bonds are very much safe, very safe, but it only offers a 1.5% yield, right? That is the thing with short-term bonds that since they are very short-term bonds, very short-term, until maturity, then they don't offer the higher interest rates, right? If you're investing directly in these bonds, you're only locking your money up for 3 to 5 years, so you're not quite as worried about what interest rates might do. So they only offer about a 1.5% yield here on this fund, but they're not going to change that much if interest rates rise or fall, right? So you did see a drop in the price of this one last year as interest rates rose, but only from $79 down to $75. So only about 5% loss on that over the last year. As interest rates come down, you will see some kind of price appreciation upside on this, but it won't be quite as much as the BLV, as those long-term bond funds. So a little bit of a trade-off. If you think interest rates are peaking right about now, then you want to get into those long-term bonds for that safety and that 4% yield. If you think rates might continue to go up a little bit more, but you still want that safety from maybe a stock market correction, or you just want the safety of bonds and want something set aside just in case stocks do come down later, then you would look to this BSV, the short-term bond fund. Another type of bond you might want to think about here is this HYG, or the JNK as well, the iShares high yield corporate bond fund. Now these are something else, right? These are, with bonds, you've got a credit rating, right? Whenever a company issues a bond, then the credit rating agencies like Standard & Poor's, like Moody's, they come out, they look at the finances of the company, and they give the bond itself a credit rating, right, as well as the issuer. So for the very strong ones like Coca-Cola, like Pepsi, like those very strong, healthy companies, they give them an investment grade credit rating. For the not so great, companies, the companies that are, not quite as strong balance sheets, then they'll give them a non-investment grade credit rating. These are sometimes called junk bonds, right? But they do pay a very strong interest rate, and the default rate on these isn't quite as bad as what you might think. Okay, they're called junk bonds, but really these bonds, they might default at a rate of maybe 3 out of every 100 at the most. They do perform a little bit worse during a recession. Obviously, these companies with a little bit shakier finances, they come under a lot more risk during a recession. I don't know that I would necessarily jump into these quite yet. If we are looking at a recession here over the next 6 months, then this might underperform. But this is one to look at as well, especially as we come out of the recession. Then you're going to get a better yield. This HYG pays a 5.3% dividend yield. It still has a relative safety versus stocks. So this isn't going to fall quite as much as stocks, even in a recession, even in a stock market crash. But that's just something to think about if you're looking at bond funds. But again, yeah, I would start looking at bonds. I know a lot of you're all in stocks, you're 100% in stocks, and that's great when stocks are going up, but you need that safety. You need at least 5-10% of your money in bonds, give you that cash flow, that cash yield, protect you from whatever may happen in the stock market, and give you the opportunity to then rebalance out of bonds into stocks if stocks do come down, in the future. So definitely be looking at bonds there. What else we got? Good for PayPal, probably not so much for eBay. Good morning. First, I got me some Maine too. So Vape King points out he's got the XLRE. We talk a lot about REITs, real estate investment trusts here on the channel. But if you don't want to pick any one individual REIT, a great way to get that real estate exposure is just go with the sector fund, right? This Spider S&P or the Spider SPDR fund. That's a ticker XLRE. That's the real estate select sector Spider fund. It owns shares of REITs in the S&P 500. Really give you that broad diversification across property types, kind of something like we talked about WP Carey, which owns those different property types. I like it for that diversification in property types, but you can get all your property types here with the XLRE fund as well. Hurrah there, brother. Billy Marion. Question do you have? What do I think of 40% gain in FedEx? Haven't covered FedEx in a while. Couldn't really tell you a whole lot about it. If you've got a 40% gain in FedEx, I think definitely, if nothing else, cover it with some covered calls. You don't have to cover the whole position, but say you have maybe 200 shares or 150 shares of FedEx. If you cover 100 shares of that, so you sell one covered call against that covers 100 shares, and you take a little bit of the risk off the table. You collect that premium. I would still sell the covered calls at a little bit higher, and I can show you what I'm thinking of. Here we'll go FDX, right? FedEx Corporation. If you go to the options here for the stock, so we can see that it's up, off the October low, 150 up to 214 right now. That's $60. So that's a pretty strong, about 40% rise from the October lows, along with the rest of the market. If you go to here to options, then you can look at where the options are trading. I usually use the January options of each year, the long-term options, just because I don't want to have to sell another cover call every month. So I'll go out here long-term to the options. We know the FedEx is traded for about 214 right now, and where you pick your strike price for your options, really up to you. How far you think the stock can go, really where you're comfortable selling the shares at. So if I said, okay, I'm comfortable selling the shares if they reach $250. If I was there at that $150 price there in October, then $250, that would be about a 66% return. So I would be happy with that return. So if I sold these $250 strike prices for next January, I would collect $13.86. Okay, so right now that is at 215, so 13.8 divided by 215. That is a 6.5% return on the stock price right now. Gives you a nice little cash bump on the shares. Protects you from about a 6.5% downside on the stock if the stock does fall, or if it stays under $250 by January. So you still get that upside to $250 by January. You take a little bit of your risk off. You get that 6.5% protection just in case shares come down a little bit. And I think it's just a great way to play, some of the stocks that have really risen, over the last month or two that you're kind of worried might not have too much further to run, especially if we do see some stock market weakness. For FedEx in particular, again, I haven't covered it much in the past. I haven't looked at it lately. One thing that does worry me is that Amazon is just dominating the logistics, the logistics landscape. Okay, everywhere you look, there is an Amazon truck. They can get a package out to you same day. In a lot of cases, they're just now expanding their drone delivery service, which is really going to expand, their capabilities there. So Amazon really seems to be building out a logistics empire that one day, could replace a lot of these other companies. So I think that is obviously a risk to FedEx. Again, I haven't really looked at it quite so much, so I can't really tell you one way or the other on the stock. What else? What do you think about VUG versus SEHD long-term hold in a self-employed IRA, right? So Mark wants to know basically two questions here. VUG, which is the Vanguard Growth Fund, versus SEHD, which is the Schwab Equity Dividend Fund. A little bit different focuses on these funds. I like both of them, but we'll talk about which one I like a little bit more there. And then, as a long-term hold in an IRA, right, a retirement account, a great idea to hold these high yield, high dividend names in a retirement account, right? One of the really missed opportunities, I think, by a lot of investors. You got to understand if you have any kind of a dividend stock or a dividend fund, especially those high yield ones, any dividends you collect every year, you're going to have to pay taxes on those. Whether you reinvest that money, whether you keep it in your account, it doesn't matter. That dividend hit your account. Your broker is going to send you a statement every year before you file taxes, and you have to pay taxes on those dividends that you collect, unless they're in retirement accounts. Okay, so if you just think about it, if you collect $100 in dividends, you got to pay, maybe $10, $15 on those, of taxes on those. You're down to $85, $90 that you can then reinvest and make more money off of that. If they're in a retirement account where you don't pay taxes until you take that money out, then you get the benefit of being able to reinvest that whole $10 or $15, back into other stocks and grow those over the years. $10 or $15 may not seem like much, but if you reinvest that every single year into more stocks, you make money off of that money. It's just a great way to use dividend stocks. Great way to grow your portfolio. So definitely, if you have those, I would start with the highest yielding stocks, the highest yielding dividend stocks that you have. Make sure you prioritize, put those in your retirement accounts, whether it's a SEP, whether it's just a traditional IRA or a Roth IRA or whatever. Now, as far as the other part of the question, which I like better, the VUG versus the SCHD. Little bit different focus here, and you can, anytime you want to see what kind of focus a fund has, you can either go to the go directly to the fund website. So if we go to Vanguard VUG ETF, okay, we can go to the fund website. You're gonna find here Investor Vanguard. You do this with any fund, and you'll be able to see the focus of the fund, what they're buying. So it says seeks the track of performance of the large cap growth index. So this is going to invest almost exclusively in large cap stocks. So very large stocks, most of them based in the United States, domestic stocks. So U.S. companies, very large companies with a growth focus, right? And then if you go down here, all of them always have a portfolio or a holdings tab where you can see the sectors in the fund as well as the specific holdings. So you can see here, this is very much a large cap growth kind of dividend fund, right? Now, if we do this with the SCHD, This is much more of a higher yielding dividend fund, right? With the VUG, we had a little bit more growth focus, so maybe you're going to see a little bit more price appreciation, but you'll probably see a lower dividend yield. So it's really kind of what you're preferring, whether you want a higher yield or a higher appreciation, right? So, for example, here we have the Vanguard dividend, or the Vanguard Growth Index Fund, VUG, only paying a 0.7% yield. So that is actually less than the stock market as a whole. Okay, if you just buy the S&P 500, the SPY ETF there, you're going to get about a 1.2% dividend yield, if I remember right. The VUG dividend fund paying less than the stock market as a whole. That is kind of an oddity, right? But you are going to get a little bit better price appreciation usually on those growthier stocks. With the SCHD, the Schwab Dividend Fund, you can get a 3.4% yield. And we can go here to holdings. We can see what those are. And if you compare those with the more, the growth stocks that we saw in the holdings of the VUG, which were a lot of the tech names, Alphabet, Microsoft, Facebook, Tesla, which is kind of odd that a growth or a dividend fund would hold shares of non-dividend paying stocks like Tesla, but it is very much a large cap growth focused fund. But if you compare that with the SCHD, you're going to see here, the SCHD has many more of the drug stocks, right? A lot more stable, lot safer drug stock companies. Merck, Amgen, you've got Pepsi, BlackRock, Lockheed Martin, Verizon here. So you've got a much more dividend focus on the SCHD. I think that's a little bit more why I like the SCHD versus the VUG. I have talked about the VUG. I like it as a growth fund. It does offer very good price appreciation. But if you're just looking at a dividend fund, you want that dividend yield, especially for an IRA, then you're going to want to go with the SCHD with its higher yield. It still has a fairly good price appreciation. We look at the 5-year chart here. So over the last 5 years, this stock has gone from about $50 to $77 here. So that's about a 50% return in the last 5 years. So that is pretty strong price appreciation as well as that higher yield. So, I like the SCHD a little bit better than the VUG, but the VUG is a solid fund as well. Okay. Troy wants to know, how do you invest in oil futures? So great question. Futures are it's a whole nother investment, and I've been meaning to make a video. I don't want to try to give you the very short and easy on futures, because there is so much that goes into these. But any broker, they're going to be able to help you open up a futures account, and in that, if you go to, you can follow futures here. If you go to the CME website, that's the Chicago Mercantile Exchange. They handle futures, and you can see this pops right up with the copper futures, which is something I look at quite a bit. Copper, a great long-term story. We are coming up to a supply deficit in copper over the next few years, especially as we, electrify the grid, electrify, how we drive, that kind of thing. This electric vehicles use 3 times more copper than a traditional combustion engine. So huge copper demand coming up, and we just have not built out our mining capacity for copper. So over the next few years, copper, I think Goldman Sachs has a $7.50 price target for copper over the next few years. You see here it's at $4 each right now. But if you go to the CME, you can go to some of the others. I talked about WTI oil. This is the West Texas Intermediate. This is the price of oil in the United States. You can see here it is at $73.60. And again, I think oil has a very strong support there, right around $72 a barrel because of the SPR and refilling that. So what you would need to do, you need to go to your broker and say, I want to open a futures account. And then you're gonna buy futures for these. Now this is it's very much more complicated than I can do in a 5-minute answer. With futures, basically you're buying. Here we can go specs. So for crude oil, if you buy one futures contracts, that is worth 1,000 barrels of oil. Okay, so 1,000 barrels of oil at 73.58 each. 73.58 times 1,000. You're buying $73,000 worth of oil. Now, the good thing here is you don't have to put up that much money to buy a futures contract. The margins are very strong. You can usually get, even upwards of 10 and 20 times leverage. So here we see the maintenance for these for one futures contract. It was $73,000 worth of oil. You only have to put up $7,000, right? So you only need 7,000. It's about a 10-to-1 leverage on that. So futures very much leveraged. That means just a 1% change in those in that price of oil. A 1% change can mean a 10% change in your futures contract, in your futures the value of your futures contract there. So definitely something you want to think about before you jump into. Maybe try following the futures, kind of doing a paper trading kind of idea where you write down in the spreadsheet, okay, I want to buy 2 contracts of crude oil at this price. You follow it for a week, see how you would have done, and kind of understand futures, learn about futures before you jump in. Because again, just as well as that, that 1% up in the price of crude oil could lead to a 10% rise in your futures investment. A 1% drop is a 10% loss, and a 5% loss, which, I mean, these like I said, 7.5% change in crude oil last week alone. That could be 70% change in your investment, and could lead to a margin call, lead to a lot of bad things. So you really do need to understand futures before you jump in there. That's why I'm kind of hesitant to say too much about futures before actually doing a very detailed, in-depth video on it. What else do we have? Do you believe REITs in general do well in a recessionary environment? So Forrest Moto wants to know, do I think REITs in general, so real estate investment trusts, can do well in a recessionary environment? I think REITs will do well this year, just because they've sold off so badly last year with that increase in interest rates. So one, you got the interest rates rose so high that REITs really sold off. I think a lot of REITs are very, very much in attractive valuation territory right now. So even if we do get a recession, it's going to hit different property types differently, and that's gonna mean different for things for different REIT stocks. But I think overall REITs will do well, just on the fact that the valuation is already very attractive for these. Now, one thing I do want to show you, and it's something we've talked about on the channel before. If you're looking at REITs, if you go to the NAREIT. So if you type in NAREIT, NAREIT, it's a National Association of Real Estate Investment Trusts, great resource for real estate investors. But if you type in NAREIT, property sector returns, or property type returns, you're going to get, the first one is going to be this performance by property subsector or sector. You click on that, and that's going to be the NAREIT, so that National Association of REITs puts this information out. It's a great resource for you to be able to see here, and to be able to track your different property types, different returns. Because for REITs, for real estate investment trusts, you really do need to think about it in terms of property types. Okay, these property types react very much differently to the economy. In a recession, obviously, I think office REITs are going to underperform, because those businesses are going to be cutting back on their on their real estate, on their office and their leases. You've got other ones like maybe medical, healthcare, that won't react quite as much to a recession, because those cash flows are a little bit more stable, right? You have to go to the doctor whether it's a recession or not. So a lot of the cash flows in that are going to be a little bit more stable. Retail probably going to underperform a little bit more in a recession, just because retail sales fall, consumer spending falls, and you get a little bit more weakness in those. So if you're investing in REITs, especially individual REITs, now this obviously, if you're in something like WP Carry, which holds many different property types, if you're in a broader real estate fund like the XLRE, you're in broad all those property types. You really don't have to worry quite as much about how the recession, how the economy affects any one property type, but just the REITs in general. But again, you can see here with this investment performance by property sector and subsector. So overall, 2023 REITs just in the last month alone already up 10%, so very strong performance by real estate, rebounding off of last year. You can see some of these office space outperforming a little bit, up 11%. Industrial, one of my favorite property types, industrial up 13.7%. That one sold off very much last year just because, over the pandemic, we had a lot of build out of warehouse and industrial space trying to find space to, to store all those e-commerce goods that were being shipped everywhere. That resulted in really an overbuilding, oversupply situation. Prices came down, and we saw a lot of these industrial REITs like Stag Industrial, one of my favorite REITs there, really come down hard last year. But that's rebounding now. It's a great long-term growth story there in the industrial retail space or industrial real estate space, especially as we bring a lot more of the manufacturing and production back to the United States in that reshoring. I think industrial is going to do very well. You can see here, residential underperformed a little bit. Obviously with the housing market slowdown, I think residential is going to continue to underperform until we hit a bottom in residential real estate. You've got lodging and resorts, really the outlier among real estate. Those hotels, people are still revenge spending as far as travel and services. Locked down in their houses over the pandemic. People are going, traveling more, staying at these resorts and the hotels. Lodging and resorts REITs up 17% already this year. So just a great way to look at those real estate investment trusts, look at the different property types, and kind of plan out your investment there. What else? Any types of REITs you're bearish on? Wow, yeah, great question by Nolan. There are any types of REITs that I'm bearish on? I would worry a little bit about those residential REITs. The housing market has not slowed down quite to the point that I think it needs to. Property prices went up so high over the last couple of years, interest rates so high that a lot of people are just priced out of the market right now. I think that's going to hurt residential REITs. I think rents are going to have to slow down the pace of increase, and there's just a lot more risk there, right, compared to some of the other property types that you might be able to invest in. I think, other than that, I think data centers are still a little bit high as far as valuation, but that's still a very good long-term play. Self-storage has come down, so there's really not a whole lot of the property types that, without looking deeper into them, that I would be bearish on. I would just be worried about residential. I would be worried about retail. I don't think retail has sold off quite as much as it needs to, especially, in a recession. I think you're going to see a bigger hit to retail, consumer spending, that kind of thing. So I would watch out for retail and residential, but the rest, they're very attractive valuations after last year's sell-off. Okay, so Gabriel, will they release the moratorium on SoFi? He's talking about the student loan moratorium. Eventually, we're going to have to start repaying our student loans. This is something that was pushed back longer than anybody thought possible, especially myself. I thought that student loan moratorium or the deferment on payments would come off last year, December at the latest. And of course, the administration, prolonged it even further. It's hard to see why people. I mean, I owe $60,000 in student loans still. Okay, I milked that baby for every year that I could. Took as much money as I could. At rates of, back then is 2002, 2003. I was getting rates of 3% on my student loans. Right, I'm still paying rates of about 3% on those student loans. So why not take all the money you can and just invest it in the stock market, whatever you don't need? That was my perspective. I still owe $60,000 on those, but there's no reason why I can't repay it. Okay, the economy has been very good, since the pandemic. Jobs market is amazing, historic low unemployment rate. There is no reason why people cannot repay their student loans. This is totally opposite from the forgiveness plan that they've got. But what we're talking about here is SoFi. SoFi, ticker SOFI, started out as a student loan consolidation, student loan repayment kind of platform, and they've since grown into a complete fintech, digital online banking kind of store, but they still have a lot of student loans on the platform that aren't being paid back right now, that aren't being serviced. So when that moratorium comes off, you could see a big bump in the shares of SoFi, as they start benefiting again from those payments. I've stopped trying to predict when that moratorium is going to come off, because the administration just is hell bent on pushing that as far as possible. I think it's going to go to the courts, and they're going to ask the courts to make people start repaying their student loans, even if they end up getting forgiven, but to just start paying back again this year. So I'm in SoFi for the long term, just on that online banking theme, and it's done very well, about 70-80% up over the last month or so. But yeah, expecting more upside when that moratorium comes off in that. Okay, Joe wants to know about Raytheon. First time AIM-9 Sidewinder shot down a balloon. Yeah, military hardware shortage everywhere. The defense stocks, Raytheon, Lockheed Martin, all getting very much support from the situation in Ukraine. Obviously, geopolitical tensions with China. I mean, these are almost becoming like staples kinds of stocks. Consumer staples, where you're going to be buying your Cheerios whether there's a recession or not. I think a lot of these defense names, we're going to be buying AIM Sidewinder missiles whether there's a recession or not. So a lot of these defense names, I think you can invest in as part of that safety portfolio and earn very good dividends to boot. Okay. David wants to know, is Amazon a buy here? I like Amazon. I hold the shares. I own the shares. We can look at what it's done over the last month, along with the rest of the market. It hasn't risen quite as much as the rest of the market. Here we can see today is selling off just slightly, but not off quite as much as the market. So that's interesting that Amazon isn't falling as much as the market. You can see year to date here, it's up from $85. So up about 17-20% here year to date. Lagging some of the other growth stocks, but I really do like Amazon. I don't think it has the risks associated with AI. So you see a lot of articles, a lot of analysis how AI, artificial intelligence, Chat GPT could force Google to lose some of its search revenue. You really don't have that weakness in Amazon. With Amazon, what I really like here, and it's something we've been watching here on the channel over the last couple of quarters, is Amazon is reporting huge growth in its advertising revenue business. Okay, this is something that Amazon has been building up. This is booked something like an 18% year-over-year growth in advertising revenues over the last couple of quarters, and so really moving into the ad space against Google, against Facebook, taking some market share away from this, because we've seen very much a different picture in the ad revenue business for Google, for Facebook, that have been reporting small, lower ad revenue growth as companies pull back on their advertising spending. Amazon, on the other hand, reporting 18% year-over-year growth in its advertising business. And what's really interesting about that is that advertising revenue, that segment, is a much higher profitability upwards of 30% profit margin on advertising revenue, versus some of these other business segments that Amazon is in, like e-commerce, where they might only collect maybe 2% net income on the sales for that segment. So I think as that advertising revenue grows, then you're going to see much higher profitability for Amazon overall. And I still like the shares. I own the shares here. They have come up quite a bit, but they're still fairly attractive valuations compared to where they were obviously here in 2020, 2021. I think if you look at Amazon on a price to sales basis, you can see here, it's trading for about 2.4. Actually, I think it's down closer to about 1 times on a price to sales basis. I don't know why Yahoo doesn't have that here, but it's trading for closer to about 2, or maybe even under 2 times price to sales. And you can see here it's traded as high as 3.7 times price to sales over the last few years here. Much more of a growth stock price to sales in the past, and now it's very attractive valuations, really price to sales as low as I've ever seen it for shares of Amazon. So again, I do like Amazon here. I own the shares. I'll probably pick up, a little bit more of the shares if it comes down any on that. You're looking at energy. What else? I own LMT for years. Yeah, so Lifters Gym, they're Chad Taylor, long-term Bowtie member, citizen of the Bowtie Nation, Bowtie ambassador there, saying he's owned LMT, so Lockheed Martin, for years now. Plans to add Northrop Grumman, ticker NOC, soon as well. What else? Some of these stocks, I just really haven't looked at for so long that I can't give you a real quick kind of buy or sell kind of decision because I don't want to make the decision off of something super quick. Airbnb, haven't covered it. I do think they can do very well. If you look at some of the and one way to play this is during earnings season, you look at some of the hotel, the travel websites, you see how they're doing. That's going to be an indication of how well Airbnb might have done during that quarter. Okay, so a lot of times if you follow earnings during the earnings season, and you follow the comparable companies, not necessarily the peers, but just the comparable companies in a space. You see how they're kind of reporting earnings, see the whether they're beating expectations or not, then you can kind of position for other stocks in that. We've seen very strong reports, last quarter and this quarter for the hotels, for other travel related, websites and property types. So I think Airbnb does very well, just on that trend. They say that you would help people creating a company. What? Yeah, not so sure about that. What do you think about Visa and MasterCard stock long term? Michael wants to know about Visa and MasterCard long term. That's such a hard one because they continue to do very well, but I always kind of wonder about competition in that space. What happens when we're all using our phones, using our digital wallets to pay for things. That's why part of the reason why I'm investing in PayPal. But now you got Apple Pay. You've got a lot of the banks creating their own digital wallets. Big news over the last couple of weeks. Banks coming together to create a digital wallet so people can pay. So you kind of wonder, what's that long-term perspective for Visa and MasterCard? They're going to have to build out their own digital wallets capabilities and things like that. They already have those to some extent. But if you look at the valuations on those, is really kind of what worries me. MasterCard. And we can look at the valuation because I know these always trade very, very expensively, relatively. I think, compared to others. You see MasterCard here, a price to sales of 15 times. Okay, that is well into growth territory. And I know they do very well as far as revenue growth, 11.5% revenue growth year over year. That isn't anything spectacular. 11% revenue growth. We can look here at the analysis to see what analysts are expecting this year and next. So this year for MasterCard, analysts expecting, 2023, analysts expecting 12.8% revenue growth, 2024, 13.6% revenue growth, earnings 12.21 this year versus 10.65, so about 20% earnings growth. So that's fairly strong, revenue and earnings growth, but it is not growth stock territory, right? So why are investors paying growth stock prices, price to sales, 15.7? I mean, generally, even if a stock is growing revenue by 20, 30, 40%, I'm not paying 15 times on a price to sales basis. That's what got a lot of people in trouble there with those growth stocks, with the meme stocks back in 2021, how they've fallen, 80% since then because people were just paying, 15, 20, 30 times on a price to sales basis. Now, obviously, MasterCard going to be able to continue that pace of sales growth, 11, even up to 15%, but it's hard to justify a 15 times price to sales ratio. You're paying $15 for every dollar in sales generated by MasterCard. And if there's any weakness in that, any weakness in their sales growth, these shares are going to get hit hard. So it's obviously one that can prove me wrong and continues to if they continue to do that. But I just have to draw a line. I cannot pay more than 10 times price to sales for any stock, no matter what their growth, especially if they're only growing revenue by 11% a year. So I choose to miss out on some of the stocks, some of the more expensive growth stocks like that, just because I don't want to have my stock fall by 50, 60, 70% if that growth trajectory comes down. Right. What else we got? Jackie says C3 AI has been popping. Looks overbought. People just keep piling in it. Is it a sell or a hold? Yeah, so AI, right? One of the stocks, we've talked about this in the past. I actually do own some shares of AI, but it's one of the stocks that I have covered with my, with covered calls, up 16%. I know this stock is up just year to date. Year to date, we could see here it's up from $11, so it's up 200%, right? 200% just year to date. Of course, with GPT, everybody piling into AI stocks. Now, I do like C3 AI over the long term. It's got a great business. Great business and products there. But again, yeah, I did cover my shares. I actually sold calls. I think I sold calls at a $40 strike price, right? Which was, let me see here. So you go to here, January 2024. Again, those just the calls that I usually use. You can use weekly, you can use monthly calls to limit that risk. I use the longer term calls because I can collect a little bit more premium, and and I don't have to mess with trying to sell calls every month or every week. But if you go out here, $40 strike price, you get $8.80 for every share, every call, or every share you've got of that. So, $8.80 divided by 30, that is a 30% cash premium you can collect on that. You still get the upside up to $40. And it's hard, like Jackie points out, it's hard to see the valuation in this stock anymore. I loved the stock at $15, $20 even, now at $30 and up to $40. It's hard to see how we aren't repeating some of the mistakes that we made in 2021 buying those growth stocks at those valuations. Okay, you can see here price to sales. Actually, that's probably outdated just now because the stock price is going up so much. We can look here at the analysis. Analysts expecting here we can see analysts for this year 2023 expecting 261 million in sales. We can look here to see what the market cap of the stock is. We see right here the market cap is right now 3.27 billion, right? So that is actually about 10 times, right? 3271, so 3,271 million divided by, what did we say? Expecting about 320 million in sales this year. That is that 10 times price to sales basis. Again, just kind of a red line for me. I don't pay more than about 10 times price to sales. Market cap divided by sales, 10 times that. I don't pay that for any growth stock, no matter how hot it is, no matter how much, analysts say the price is going up, anything like that, because I don't want to get caught on the downside. Okay. So again, I've sold the $40 covered calls on my AI, on my C3 AI, that's ticker AI shares. I could still collect, I've still got that 30%, well, up to 40. So I've still got a 30% upside on the shares. If they do reach $40, I collected that 30% cash premium, by selling the calls. So, it's still a very good return, even if the shares continue to go higher, but I've still protected myself because I've sold those calls against that. What else we got here? Justin wants to know about Nike. Is Nike too expensive? Now, Nike, so, the big factors for Nike, of course, are going to be China. There's, very much the China growth story, as well as, retail spending here in the United States. We can see it's down 2.3% here today so far. We can see it is up, from $83 at that September low. Year to date, it's up 118 up to 124. So it hasn't run quite as much as obviously as some of those growth stocks that we've seen here to year to date. But it is up quite a bit, from the lows in there in September, October. If we say 85, it's 15, 40. It's up, upwards of about 50%, almost 50% since September, October there. If we do look at the statistics here, the price to sales, so price to sales of 4.2. So price to sales ratio of 4.2 times for Nike. We can see here the history. I mean, it does generally trend, for in the fours, even up to 5.9 times there in 2021. So a little bit higher. Kind of surprises me because, I mean, that's almost up there in growth stock territory, right? When you're having to pay four and 5 times price to sales ratio for a stock, I mean, you're expecting sales to grow at 20-30% a year. Trailing PE, so price to earnings ratio, up at 36. I mean, that does kind of worry me a little bit. Revenue growth is at 17%, so it's strong revenue growth. I think it's really come off of, the slowdown fears in China. I think they're really benefiting from the reopening in China. Again, like I said, Nike is very much a China growth story. How much sales are growing there in China, and as China opens up, its economy from those COVID lockdowns that have really hit the economy over the last 3 years, I think you're seeing a lot of that reflected here in shares of Nike. As a really risk-averse investor, I would be worried here about the price right now. Again, probably cover this a little bit with maybe some covered calls, just to take some risk out of that price that I think is getting a little ahead of itself. And what I'm talking about here, folks, when I say a lot of these stocks are getting a little ahead of themselves, is just the general market. Like I said, again, so far in the fourth quarter, earnings that are being reported right now, companies are reporting on average a decline of 5% in their profits on a year-over-year basis against the fourth quarter of 2021 versus 2022. 5% decline in profits. Analysts are expecting that to continue. 4% in the first quarter, or for the first quarter, and another, like 3% for the second quarter. So we are expecting 3 consecutive quarters where companies are saying, okay, we're making less money than we did on a year-over-year basis. Overall, total S&P 500, analysts are now only expecting the stocks in that index to report $225 in earnings, in per share earnings. That's only about 3% higher from last year. And I want to show you how to find all this. All you out there, all you members of the Bowtie Nation out there know I love FactSite Earnings Insight. If you type in Google, you can go to Google and just type in FactSet Earnings Insight, FACT set Earnings Insight. You can see here it pops up for me because I search for it so much. But it's the first hit you're going to get is the PDF they put out every Friday. They update this every Friday. And it's just a tool that they use they follow all the earnings reported by companies. They follow analysts' expectations of those earnings, and they report that back to you with some great charts and some great information. Here we go. Here we can see, if we scroll down here into the into the expectations, what I'm looking at here. So you can see here, earnings decline so far this quarter, 5.3%. You can see here the expectations for this year. If we scroll down, here we go. So the earnings, S&P 500 expected earnings for the 2023. You can see here for the first quarter, expecting 4.2% decline in earnings, a revenue growth of just 2%. For the second quarter, based on the economy, based on all the negative warnings we're getting from companies that they're reporting their fourth quarter earnings, they're expecting a drop of 0.1%, so 0.1% drop in revenue and a 2.9% drop in earnings for the second quarter. So again, that would be 3 consecutive quarters where companies saying, okay, we're making less money than we did a year ago. Total earnings growth for 2023 only up 3%. And I could show you the where I'm finding the $250 number. If you scroll down here, it's one of the last charts they have in here. You find the price to earnings ratio. We'll talk about that. But here is Here we go. Okay, you can see here the S&P 500. So analysts are now expecting all the companies in the S&P 500, right? The 500 largest companies based in the United States, only expecting them to report $225 in earnings per share for 2023. That is only 3% higher from last year. So definitely a slowdown in corporate profits, in profitability, in corporate profits. If you just take what we're looking at, as far as where the index is right now versus versus the earnings. I mean, we've given back a lot of the value that we saw back in October. Okay, in October, the S&P 500, the stock market in general, fell to 3,500. That was about 15 times on a price to earnings basis. Great point to be buying stocks. You can see here it was actually right around 16, 17 times where it hit. You could see right around this line here where it hit in October, where it hit there in in the first sell-off there in March and April. But now it's back up here to this long-term average. This blue dashed line is the 10-year average PE ratio, so the price to earnings ratio, up there right at around 20.1, 20.2. It is back up to that point. So stocks are no longer as cheap as they were, in the stock market crash of last year. Not necessarily expensive either. You can see here that, during the good times, the bull market, it reaches upwards of 22, 23, 24. It even reached as high as 34 here in the frenzy of 2021. So not necessarily expensive, but no longer cheap either. And just kind of using that data, that idea that we're expecting 3 consecutive quarters of negative earnings growth. The Fed has repeatedly warned investors that they're going to keep interest rates high until inflation comes down to its target. So I think you're going to get to a point where investors say, okay, you know what, interest rates are going to stay high. It is clearly slowing down the economy. Corporate earnings, which are the backbone of valuation for stocks, they are continuing to come down. We're not so quite as positive on stocks as we have been over the past couple of months. So I am expecting some kind of a pullback in the markets over the next couple of months, give back some of this rally that we've enjoyed. So I'm locking in some of those profits with those covered calls and things like that. What else? What else we have? Could you make a video, post small caps, penny stocks? So Lifter's Gym, Lifter Chad there asks, can you make a video or a post on small caps and penny stocks for the current market environment? Researching these, invest 4 to 5 years, 4 to 5 as long shots. Great question. And actually, I've got a small cap, a penny stocks video coming up, not this Wednesday, but the next. I already created it. It's just in post production and editing right now. And why I want to talk about penny stocks right now, and some of the best, some of the ones I want to highlight, is because now could be the best time to invest in penny stocks, right? These small cap companies, these companies of a market cap of less than $1 billion, you're going to see a bigger sell-off of those in a recession, or as we lead into a stock market crash, just because these companies are smaller. They've got less financial power to withstand whatever the economy throws at them. So you saw a huge sell-off in a lot of those penny stocks, a lot of the small cap stocks last year. But what you got to understand is, when the market rebounds, when the economy rebounds, these are obviously going to grow even faster. And again, we're fighting the yard keepers outside, but they'll be done in here about 3 minutes. But yeah, when there's blood in the streets, when everyone else is selling, is when you want to look at those types of stocks. So I'm going to be covering my 7 favorite penny stocks here over the next week in that video. Got that coming up. And got that coming for you. What else? Starbucks stock. So Temporary Space Studios wants to know about Starbucks stock. Stock went down 4% in a day. Can you comment on that? I don't know what's happening with Starbucks. We can look at it real quick here to see if we can see. It's obviously it's probably on their earnings, right? A lot of the stocks, if you see a big move in a stock in any one particular day, especially if it's around earnings season, then that's usually going to be what happened. Is it reported negative earnings? So it's stock transcript. If you scroll down here in the new coming, if you scroll down in the news, you can usually see if it did report earnings and and if that's it. So, and we can see here, in the earnings for Starbucks, they did report earnings. They missed earnings expectations. They missed on the earnings by about 2 cents. So they reported 75 cents in earnings per share. Market was expecting 77 cents in earnings. And what you got to understand, folks, is companies that don't beat their earnings expectations, that is a big negative for the stocks, because companies always beat earnings expectations, right? Historically, on a 5-year average, 77% of the companies reporting their earnings have beaten earnings expectations, because it's a game they all play, right? It's a game they play with analysts. Companies will come out during an earnings call, say, okay, this is what we did for the last 3 months. This is what we're looking at for the next 3 months, and for the, usually for the year. And they'll give earnings warnings. They'll say everything they can to bring those expectations of future earnings, of the current quarter earnings, as well as the whole year. They'll say everything they can to bring those down, just to make it easier to beat those when they actually do come out and report earnings. Okay, because one, you look a hell of a lot better as a manager if you can beat what everyone was expecting. If here in Starbucks case, if the analysts are saying we think Starbucks, on what they've said in the past, on trends, economic trends, we think they can report 77 cents a share for the earnings for the fourth quarter. If you come out with 80 cents a share earnings, then you look like a shit hot manager, right? You're getting more money, and a higher bonus in your paycheck. On the other hand, like we saw, if they only report 75 cents a share, then, people, investors, and the analysts in the Wall Street, they're going to start saying, well, what's happening there at Starbucks? Why isn't management able to keep up with these expectations and with the rest of the economy? So that's why they kind of play this game of lowering the earnings expectations so they can beat those in the future. And that's why 77% of companies on a 5-year average, 77% of companies beat their earnings expectations. So don't think that, just because a company comes out and beats their earnings expectations, reports earnings and sales above what people are expecting, that's anything really that great. It's just the game they play. What is bad is, again, when they miss those earnings expectations, you really gotta start to think, okay, what went wrong here? Why did they miss those? So that's why you see a big sell-off in the companies when they miss their earnings expectations, and not necessarily a big jump when they beat. If they only beat by a penny or two on those, you don't necessarily see the stock jump as much as when they do beat those. Now, for Starbucks specifically, I can't really tell you what happened there as far as why they beat or why they missed expectations and that kind of thing, because I really haven't followed the stock quite so much. I'll look into it though, and get back to you in our next one. So Troy wants to know Amazon versus Baba versus Melly versus JMIA, a Royal Rumble of online retailers. Great idea there. I do actually own shares of Amazon and Alibaba. I think Alibaba is very much undervalued, even with the rise that we've seen over the last couple of months. I think it's still, valuation is still very strong there. I think we're going to get some very good numbers out of China as far as economic growth and that rebound. They are going to be, the economy there has been locked down for the last 3 years. Very poor economic growth in China. In fact, last year had its worst growth since like the 60s. I think we're going to see China is growing its economy while the rest of the world is going into a recession and seeing declining economy. So I think that's really going to support a lot of those Chinese stocks, Alibaba especially. As got its finger on e-commerce and the economic growth there. So I do like Alibaba. I do like Amazon though as well, like we talked about before. Really haven't covered Mercado Libre or JMIA quite as much. One thing that kind of worries me about a lot of the other emerging market stocks, right? This Mercado Libre, JMIA, really the whole emerging market sphere. And believe me, I drank the emerging market punch for many years. I started out my analyst career writing for emerging market analysis. I actually was at a Bloomberg conference, asked to talk at a Bloomberg conference on the exchange integration between Colombia, Peru, and Chile back in 2011. I went to a conference and was asked to talk there. Loved emerging market stocks back then, but just over after 10 years of living in an emerging market, really studying the markets and studying stocks there, I think it's a myth, that whole convergence of emerging markets and growth there. It is a myth. If you look at some of those countries, the economic growth, the stocks, they do very well for periods of 3, maybe even 5 years, but then they crash down so much harder than other stocks in any kind of a recession when inflation kicks up, that it really just wipes out all your gains. So I think there's better ways to get that growth in your portfolio rather than trying to look for it in emerging stocks. So that's why I generally actually just kind of avoid emerging market stocks altogether. Other than some Asian shares, things like TSMC, Taiwan Semiconductor, other than some Chinese shares like Alibaba, things like that. Then I generally tend to avoid some of the emerging market names. Gabriel wants to know, do I have a video on covered calls, how to do covered calls? I do, actually. I should point that out. Let's go here. If you ever want to find a video or some ideas, you can always go to the channel and search in videos. So we'll go here, go to the channel here. Oh, look, we're live. Go to videos here. And if you go to videos and then you click on this little search, this little hourglass, go covered calls, or you can search for options, covered calls. You can search for options there. Okay, so there's going to give you those. But what you want to do, you search for options. And we'll go 5 option strategies for beginners. These are my 5 favorite option strategies. You can see here it's 381,000 views. One of the most popular videos on the channel there, and it's going to start off with a covered call option strategy. Actually, that's the first one. It's the one I use the most out of all my option strategies. That covered call strategy, just because it does give you a great way to cash flow your investments, reduce your risk. You can actually turn non-dividend paying stocks into something like a dividend, collect cash on those. So it's a great investing strategy to have in your toolbox there. So again, just go to the videos, go search for options, and you'll find this 5 options trading strategies for beginners. But great question there. Amazon, do you have a course covering the stock market? So, okay, yeah, funny. Canadian Hobbit wants to know, you mean China isn't doomed like every other YouTube keeps saying? Yeah, I mean, you got to understand about YouTube, folks. There is, right now there's a very strong trend on YouTube for indignation. Okay, you see a lot of these or shared indignation. You see a lot of these channels pop up that just want to bash on whatever idea is out there, or say that you've been lied to, or you've been fooled, and here's why. And people love that kind of idea that uncovering the scams and the spam and the lies and all that. But it's not all true. Okay, you see a lot of these videos how China is going to collapse, and everything is going to just go to hell, and it's never going to happen. Okay, you got to understand, China has trillions of dollars in reserves, in other assets that it can apply as a state-controlled economy. It can very much more control its economy than you have maybe with the U.S. or some other developed markets like Europe. So it's just not going to happen. Okay, I'm not trying to stick up for the communist government, right? Obviously, I'm a patriot to my bones, but you just got to be impassionate here when you're investing. Okay, fight for freedom, fight for America, but invest with your pocketbook and invest what's going to get you the best return. And that's why I own shares of Alibaba. I have looked at Chinese stocks in the past, and I'm not going to avoid them just because I'm a patriot. So yeah, don't believe everything you hear on the internet or on YouTube. So lesson number 1, I guess. So in last week, beginning investors. Okay, just joining. What platform do you say is the easiest or best for beginners to break into stock investing? So Alan has a great question here. Just joining. What platform do you think is easiest or best for beginners to break into stock investing? Great question. I use like 7 different platforms, investing platforms. One, to get all the free shit. Okay, you get free stocks just for joining platforms. I'm on Webull for free stocks. I've started on Mubu for free stocks. Others I use for For research, E-Trade is great for research, low cost, no cost stock investing, things like that. For beginners, a great site is M1 Finance, right? And it's M1 Finance. Basically, it's you set up what stocks you want in your portfolio. You set up how much of your portfolio in each of those, so you can put a percentage. So say you want 10% in Coca-Cola, you want 10% in Pepsi, you want 10% in the SCHD fund or something like that, right? So you set up the percentages, and then you can just put money in every month, and it'll automatically divide that money by those percentages, or however much you want in each stock, and just automatically invest for you. It's a great way to kind of get your portfolio started, get yourself started in investing, and not really have to worry about stock picking or that kind of thing. Not have to worry about managing it too much yourself. So great feature, I guess, that automated investing feature they have there. I would recommend that. E-Trade probably has some of the best customer service that I've seen. I've been on E-Trade since 1999 when it was Brown and Company, before they bought them out, while I was still a Marine on base, using the base library PC, trying to get online. So they've got great customer service, and they're going to help you all along as well. So dividends. I've been collecting dividends on SoFi and others. Yeah. Yep. So Ambrose says he's been collecting dividends on SoFi and others. Again, that covered call strategy, a great way to collect what's like a dividend, a cash return on stocks that don't pay dividends. Now, there is a risk to that. Obviously, if you're selling those covered calls for that price, then you're basically, you're agreeing to sell that stock at that price. So I generally don't sell covered calls on my really great long-term forever growth stocks like SoFi, like Teladoc, things like that, things that, stocks that could go up 15, 20, 30%, here in a month or two, because you're going to miss out on some of that return if they go over that price that you've sold the covered calls for. So, some of the stocks like C3AI that are just approaching crazy, insane valuations. Some of the stocks that, that I don't necessarily want to hold for 5, 10, 15 years, then I'll sell those covered calls. I'll take some of the risk off of those. But some of the forever stocks that I just want to hold and just let them go up 10 times my money, then you got to kind of worry about getting, selling, having to being forced to sell those shares because of those covered calls. But yeah, great way to cash flow your stocks too. UAN. Okay, so Easy 4009 wants to know about UAN. We'll cover that. Haven't covered that in quite a while here. I know that is a fertilizer stock. Here we are, CVR Partners. So this is a master limited partnership for fertilizer. I do like the shares as kind of a diversification. Usually, if you're investing in these high yield stocks, these very high yield stocks, and these master limited partnerships, usually they are either like pipelines, oil and gas pipelines. They're either MREITs, mortgage REITs, or they are BDCs, business development corporations. With UAN here, with CVR Partners, you're getting a fertilizer stock, right? So you're getting a completely different business type of business, and a little bit more diversification in those. Now, that 19% dividend yield kind of worries me a little bit. I don't think that's sustainable. So I would expect them to come out and say, look, you know what, we're going to probably cut our dividend a little bit just to protect cash flow. You can see the dividend history here of a stock and see kind of, if they've cut it in the past, which is obviously, a sign that they could cut it in the future, that dividend cuts are common. And with CVR, with a lot of these MLPs, as well as REITs, you do see the dividend jump around quite a bit, because these aren't necessarily ones that are going to set a dividend payment and then keep that and gradually increase it. These companies, these master limited partnerships and the REITs, they're paying out 90% of their earnings as dividends, and that fluctuates, obviously. So they're going to fluctuate the dividend, whatever they're earning from quarter to quarter. That's about how much they're going to pay out. So you can't expect really that same dividend or that dividend stability that you get with a lot of other stocks. But you do see here that, just with the strength in fertilizer prices over the last couple of years, especially as, when Russia invaded Ukraine, you had very strong very strong earnings for something like this. Again, I wouldn't expect them to be able to keep on this kind of a dividend payment and pay out 19% on the shares, but I do like the shares as a long-term kind of way to diversify your high yield portfolio. So, if we look at the stock price is basically flat, which is what you're going to expect from a lot of these high yield stocks. They're going to pay out all their earnings, and they're not really holding anything back for growth. So you're not going to get a whole lot of growth in price appreciation. You're just going to get those dividend yields. Again, expect that dividend yield to come down a little bit, but I still do like the stock as just kind of a great cash flow stock that's going to diversify your high yield portfolio away from mortgage REITs, BDCs, other types of MLPs, things like that. Carmelo says, are you still holding Chevron? I am not, actually. I sold Chevron, just over this last month here. Had some covered calls, expired and sold it with that. I'm waiting for it to come down just a little bit more. We talked about energy stocks here earlier in the live stream, how they are coming up against some very tough comparables last year. Okay, energy prices, oil prices are very high last year in the first half of the year on that invasion of Ukraine, up to $120 a barrel. Now, over these next 2 quarters, energy companies are going to be reporting a drop in revenue and a drop in earnings on a year-over-year basis, right? A drop in that growth, right? They're still going to be reporting very strong cash flow, still going to be able to support those dividends, but it's just a very hard comparison on a year-over-year basis for these 2 quarters. We also see that oil has come down to $73 a barrel. It is now down negative so far for today, $72 a barrel. Again, I am buying oil directly through futures, right around that $70 to $72, $73 price point for oil. If it comes down further and brings these stocks down further, then I'd get back in these stocks. Again, Chevron is probably one of my 2 or 3 favorite oil companies, just because its cost of production is so much lower than a lot of other the majors. So they will be able to support that 3.5% dividend yield. Their cost of production right around $35 a barrel. So very much still a cash flow company, a cash flow positive company, and that. But I am hoping to see maybe a little bit lower prices. I'd probably come in here probably closer to 160, 165. So very close to where it is now. I think you can start buying back into those shares. What else? Dollar cost average index fund. I haven't been able to pull a trigger given the run up. Any thoughts on where to start dollar cost now or wait? So Vipul has a great question here. He wants to get into the market, start dollar cost averaging into an index fund, but he hasn't been able to pull the trigger because of this run up. Because of the huge return that stocks have. S&P 500 alone up about 7% so far this year. So you kind of wonder, as we've talked about, if we're going to give back some of that money. Of course, you never want to just start investing and see your stocks fall right off the bat. So disillusioning. But there is some ways you can do this, especially if you're talking about like an index fund there. You can buy the index fund and sell some covered calls against it, just to kind of reduce your risk a little bit. That way you're in it there. One thing, there's nothing wrong with holding a little bit of cash, right, folks? Nothing wrong with holding maybe 10% of your portfolio, maybe even 5% of your portfolio in cash, waiting for those better prices. You can buy some of those bond funds that we talked about. So I would look at, if you just want a very simple 2-stock portfolio while you're learning how to invest, okay? There's nothing that says you got to jump right in and start picking stocks. If you're just starting to invest, pick 1 bond fund and 1 stock fund, invest in those. And while you're learning how to pick stocks, or while you're learning about ETFs and things like that. So what you do, for a bond fund, we talked about a couple of bond funds there. We talked about the BLV as well as the BSV. Now, I think as of now, I think I would start transitioning into that long-term bond fund. That here we have the long-term, the BLV, the Vanguard Long-Term Bond Fund. It's ticker BLV, pays a 4% dividend yield. Again, it is going to protect you from, if stocks fall. It is going to protect you, in that stock crash environment. Going to give you a little bit of a return, and protect your money. For the overall stock fund, you can go things like, you can go clear out to world stock funds. I like the SPY, the Spider S&P 500 Trust, and I'll tell you why. This owns the 500 largest stocks in the United States, right? It is the basically the stock market index that we use. It pays a 1.6% dividend yield, so not much to speak of there. But I know a lot of people use the something like the VTI, right? Which is the total stock market index fund. That's all the stocks, here I believe it's all the stocks in the US. They've also got, all the stocks internationally. But if you look at these, so we'll look at the holdings for the Spider S&P 500 ETF first. Okay, you look at the holdings and you see, Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, the 500 largest companies in the United States ranked by size, right? By market cap. So, the largest companies, Apple, Microsoft, going to be on top there. Amazon, all trillion-dollar companies, you're going to get with that SPY. Now, if you instead you say, hey, I don't want just that 500 companies. I want the entire stock market. I want complete diversification. The thing is, what you get when you get these total stock market funds is basically the same thing. I mean, if you look at the holdings here with the VTI and you scroll down, Apple, Microsoft, Amazon, Facebook, Berkshire Hathaway, it's almost the exact same thing. And if you look at the assets, I mean, just these top 10 here are 20-30% of the fund, just because it is a market cap weighted fund. So it is going to take the largest stocks, the largest companies. It is going to put more money in those as a percentage, because those are the largest companies, as a percentage of the total market. So don't think that just because you're in the VTI, then you get much more diversification. You are still basically in the SPY, in the S&P 500 fund. That's why I just like the SPY in itself. But you can start with the VTI, you can start with the SPY, any kind of a broad stock market fund. Somebody's talking about the SPHD, the low volatility ETF. That is also a great fund to start with, SPHD. So you've got the Invesco S&P High Dividend Low Volatility Fund. That is also going to hold a lot of your large cap S&P 500 companies, right? It's a little bit more focused towards dividends, right? So Iron Mountain, Altria, Williams, AT&T, Kinder Morgan. So very much more of a dividend focused fund rather than a whole stock market fund, but also a very strong fund to go with, as well as maybe that SCHD. So basically, again, here, if you're just starting out in the market, you want to put your money to work, but you're kind of worried about whether stocks will come back a little bit off of this huge run up they've had, then put some money in a stock market fund, a broad fund like the SPHD, like the VTI, like the SPY, or maybe the SCHD, and then some money in that bond fund. Okay. You can sell some covered calls against the stock fund if you want, but even if you don't sell covered calls against those, you got that bond fund, right? You got that bond money set aside. If stocks do come down quite a bit, you're going to save your money. You're going to protect your money in the bond fund. You can then transfer some of that into the stock fund, take advantage of those new lower prices. And this is all while you start learning a little bit more about investing and how to invest and that kind of thing. So, don't feel like you have to jump in and pick stocks really ever. You could have a 3 ETF portfolio forever, never have to worry about picking stocks, and just don't have to worry about it. But this is a great way to learn and put your money to work as you are. Jesse wants to know how do you know if an ETF is overvalued? Great question there. Obviously we talk about the valuations and the analysis for individual stocks. It gets a little bit harder for those ETFs though, doesn't it? Because they might own, that SPI owns 500 shares. The VTI I think is something like 4,000 companies. Most of these hold hundreds or thousands of stocks. So, but if you ever want to look at the valuations, almost all companies are going to give you the valuations of the stocks in that. If we go to, so something like the SPY, type in Google SPY ETF. Any ETF, any exchange traded fund is going to have a main page, right? You type in Google, type the ETF in there. It's usually going to be one of the first ones you see, right? Here with the Spider SPY, the ssga.com. So you go here, you click through that, And again, it's going to show you, it's going to give you a fact sheet you can download, but it's going to give you the all the statistics here, okay, the higher level statistics. It's going to give you, you got earnings per share growth, 11.7%, price to book values, price to earnings. So you can kind of compare that price to earnings against the market as a whole. You can see, usually price to cash flow. You just got a lot of valuation, on the stock here. And then, of course, again, you can see the individual stocks in this. And why I like looking at the individual stocks, because a lot of times the top 10 stocks in a fund are really, that fund are really what's going to move direct the fund price, because there's so much in these. If you look at here, Apple and Microsoft alone are over 12% of this fund, over 12% of the S&P 500. So whichever direction Apple and Microsoft go, a lot of times that's the direction the S&P 500 is going to go. You fill that in with Amazon, Alphabet. These top 10. You can kind of do individual analysis on these top 10, and that's kind of your analysis for the SPY as well, because so much of the SPY is in just these top 10 companies, and that's usually true for any ETF. Usually the top 10 stocks in it are a large part of the holdings. But again, you can go through here and just look at the index level or the ETF level statistics, like price to earnings here. Kind of compare that against the rest of the market and against what you think the market is going to do. Okay. What else here? I'm going to scroll up, see if I missed any. If I missed any questions, make sure you go ahead and re-ask them. So if I missed them in the comments. Random shiz. I like that. Random shiz wants to know about natural gas in general. My thoughts. Natural gas has been crazy. It is down from $7. $7 just late last year, down to about $2.50. It's the lowest price it's been since in more than a year. And it's a lot of it's due to higher temperatures here in the U.S., here in Europe, there in Europe, as well as a shutdown of a major export facility here in the U.S., the Freeport LNG liquefaction facility. That was, I think that's like 5% alone, maybe 5-10% of the liquefied natural gas export market for the U.S., right? So when that shut down here quite a few months ago, about 6 months ago, I think that was, that shut down. So I had some problems there. That dropped the amount of LNG, the amount of natural gas that we export from the United States. Obviously, that boosted the supply here in the United States and lowered that price. In Europe, record high temperatures over this winter has really hit the demand for natural gas as a heating source. They've also dropped their demand usage on that. I am bullish though at this point on natural gas. We are Europe is going to have a very tough time refilling its capacity for next winter because it is totally weaning itself off of Russian natural gas. Here in the United States, we are exporting it more and more. We are becoming a natural gas exporter to not only Europe but also Asia. I think that economic growth in Asia, in China particularly, is going to increase demand for natural gas. And right here, I think these are just really good prices for natural gas. So I actually have a couple of long futures contracts in natural gas. See if that goes up any. It's not quite as easy, it's not quite as bullish as crude, as WTI crude, just because you don't have quite the support, the floor of support from refilling the SPR for crude. So, but I do like natural gas. What else? Any other questions here? Where do you buy futures? Where do you buy your futures? I just use E-Trade. E-Trade can open an account really easy for you for futures, and then it moves money automatically from your main brokerage account. It'll move money automatically to your futures account to trade, and satisfy margin calls. It's just a really easy way to do futures there on E-Trade. Good for beginner. Just Laces asks if the SBHD that we just talked about, the low volatility ETF, is a good for beginners. Great fund. The SBHD low volatility ETF, again, very much dividend focused, so not going to give you quite the broad stock market exposure that maybe something like the VTI or the SPY is going to give you, but it is a good fund. I prefer the SCHD a little bit more, just for the dividend yield, but I think the SPHD is also a very good broad dividend fund that is going to do very well for you. And I think a lot of these dividend funds, the value funds, which tend to be very similar, just because these value stocks are also the dividend payers, I think they're going to do very well over the next couple of years against growth stocks. With these higher interest rates that we've seen, over the past 20 years, we've seen growth stocks, or over the past 10 years, we've really seen growth stocks beat value stocks. Just because, with low interest rates, those growth stocks the future cash flows of those growth stocks are worth more. As the interest rates rise, though, and as the Fed keeps interest rates where they are, you really got to wonder if value stocks and dividend stocks aren't going to now outperform the growth stocks like we've seen, as opposed to what we've seen over the past 10 years. Historically, before interest rates came down so much over the last 10, 20 years, really, then value stocks did beat growth stocks because of those interest rates were so high. And, you got to understand interest rates are kind of an opportunity cost for growth stocks, right? If your growth stock isn't paying a dividend, then you're kind of missing out on that opportunity, that higher interest rate through bonds or through dividend stocks. So I kind of wonder if, dividend stocks aren't going to outperform growth stocks, and value stocks aren't going to outperform growth stocks as well here at least over the next year or so. Okay. Ooh, Lifter's Jim wants to know, got a question, what is your favorite long-term stock and favorite short-term stock? That is a hard one. Just put me on the quick and ready. Favorite long-term stock would be easy. I'd have to go with SoFi. SoFi Technologies, ticker SOFI. And SoFi Technologies, ticker SOFI here. Again, that's one that we've talked about quite a bit on the channel before. I actually we just got positive in our position last week. I've been buying since January of last year, which you could see, last year, even after it was down from about $20 a share, at its peak in 2021. I started buying right around $12 a share in January of last year, and it was still hurting us. But $6.70 was my cost basis here, and we just passed that last week. Now at $7.45 a share, we're looking at a pretty good return already. And I think this is so right now this is a $6 billion stock market cap. I think this could be easily $20 billion company over the next 5 or 10 years. We've talked about SoFi on the channel quite a bit. It has a banking license, which means it has access to those deposit rates. It can collect deposits from customers just like a traditional bank. It can use those deposits for loans. That's something a lot of fintech, a lot of digital online banks do not have. Okay, they're not actual banks in the traditional sense because they don't have a banking license. So they don't have that cheap funding source, right? They don't have those deposits that they're only paying out, maybe 1% or 2% on those deposits, and then lending that out on personal loans, on long-term mortgages, things like that. So I think, SoFi, as we've seen here just in the last, so far year to date, has a huge advantage in that fintech digital wallet space, that online banking space. And again, I think this is one that goes, much, much higher, $20 billion bank, here over the next 10 years. So that's one of my largest positions. Obviously, all you out there in the Bowtie Nation, you've heard me talk about Teladoc quite a bit. I also like Teladoc. I'm still holding on to PayPal. I think that one does well. Short-term stocks. One stock that I've really been interested in, I bought some shares in it last month, just because, it did so poorly last year, is Generac Holdings. That's ticker GNRC. And I mean, this one might transition into more of a long-term pick as well, but I do really like it for the shorter term. Also, you can see here it is down from $500 at that peak there in 2021, so it is down hard. But a lot of the sell-off last year and over the last couple of years for Generac Holdings, if you don't know, Generac is, I mean, the far and away leader in portable generators, right? Here in Florida, we are big into generators because, it's inevitable every year your power is going to get knocked out by some hurricane. So I think Generac controls something like 80% of the portable generator market, which is a commanding market share. Nobody else is going to ever touch that. So they control that market, which is great to see because it is a cash flow market, right? Every year, people are going to need to be buying generators, things like that. Now, the problem with this stock over the last year really is that they've been trying to diversify into solar energy. Okay, they've been trying to, because there's not a whole lot of growth in portable generators. You get that consistent year-over-year cash flow, but it's not like it's going to grow by leaps and bounds every single year. You only have so many hurricanes, so many tornadoes, and things every year that people rush out and buy portable generators. So it's a very slow slow, steady growth rate. So they've been trying to transition into solar panels and other solar energy ideas. That has obviously kind of spooked investors. It is pulled back on the cash flow for this company, right? Obviously they need to acquire companies with the solar technology. They need to build out research and development for solar technology. So it is slowed down the earnings for this company. The thing is, obviously solar renewable energy has sold off over the last couple of years, especially with that rise in interest rates over the last year. So that's hurt, any company in solar energy, but also just because, it's as people are worried about the competition in the space with Generac being a new entrant. But what I like about GNRC is that it does have that stable cash flow from generators still. Okay, unlike a lot of other solar companies where their year-to-year earnings, their year-to-year sales was really volatile. Depending on what the space is and what the growth is in solar panels, solar batteries, things like that. Generac instead has this stable cash flow from its portable generators segment that it can use to fund that research and development as well as the acquisitions in solar panels, right? So it's kind of a best of both worlds. It is a stable cash flow stock on that generator side. It is a growth stock on the solar panel side, and I think they're really going to use that to their advantage. It's trading at a very attractive price to earnings, price to sales basis right now. I think it's up something like 15% so far year to date. I bought it early January there, right around $100 a share. It's up about 20% now. But you can see where there's still value in this stock. So I do like shares of Generac on a shorter term basis. If they can build out that solar operations, then I think it goes much higher, over the long term as well. But definitely one that I think is gonna do well near term also. Okay. Oh, Chad say you're going 15% into SoFi. Call you crazy. Yes, you are crazy. Folks, come on. I don't know. I don't care what stock it is. Please, 15% is probably a little too much. I know, hey, I love SoFi. I think it's going to do very well. And it's a moonshot investment. More power to you, brother. But, 15% in any one stock, it is just dangerous. It is just scary because, bad things happen to good companies. We've seen examples of that everywhere. Wells Fargo, used to be a great stock, and then they got hit by the scandal. Stocks like GE, that used to be something everybody owned. Everybody owned GE. It used to be a consistent provider, and then it just crashed. It just did nothing for years and years. Finally started to come back with a spinoff. But bad things happen to good companies. Having 15% of your money in any one stock, it's just scary. You're going to prove me wrong here in the next 10 years, and you're going to be a millionaire many times over, and I'm going to be sitting in some of these stocks. But 15% is kind of risky. Okay, all you out there in the Bowtie Nation, I usually say no more than about 5 to 7% of your money in a stock. If you're just starting in on a stock, maybe put 3% of your money at the most in it. That way, if it does come down, you can put a little bit more money and not bump up against that 5 or 7% rule. But spread yourself out a little bit. Find some other stocks to invest in. Have no more than 5 or 7% of your money in one stock. That way, just in case something bad happens to it, then you're not totally distraught and frustrated with your portfolio on that. But hey, Chad's a good investor there, so he might prove me wrong on that one. What else? 7,000. Please explain why Generac doesn't pop up in 5 best portable generators. I don't know. I mean, so Micah wants to know why Generac doesn't pop up in the 5 best portable generators. So one thing you got to understand, if you're doing kind of your research like that on maybe Google or something, is you got to understand a lot of bloggers, they've got ulterior motives as far as what they're going to promote, right? They might promote something else. So you type in 5 best portable generators, and you're going to get a blog list of things. One, companies that pay out higher affiliate payments or pay out higher commissions to the bloggers. So bloggers are going to tend to, going to tend to highlight the companies or the relationships they have with other companies. They're going to tend to maybe highlight the more expensive ones on Amazon, so they get a little bit higher commission if people click through and buy those. So not necessarily probably the best portable generators if you type that in. Now, again, what I will say is that Generac owns like 80% of the portable generator market. A very, very large commanding share. And some of the brand names probably, don't necessarily say Generac on them. They've got just like a lot of companies, they've got their brand, their main brand, and then maybe they produce value brands as well that have maybe a little bit fewer features, maybe a little bit, not quite the quality, but lower price kind of thing. So, that's why it might not look like a Generac port generator, but it is in the end, and they do own, control that large market share. Bill wants to know about Bank of America. Actually covered Bank of America along with JP Morgan in Friday's video. Friday's This Versus That video. Great series, of videos there on the channel. Check that out. Basically, every week on Friday, we're comparing 6 stocks, against each other, 2 stocks against 2 stocks. So I had JP Morgan versus Bank of America. And what we saw with these two was what you see a lot with a lot of the stocks, right? You go JP Morgan, very clearly, undeniably the leader in banking, much better profitability, much better fundamentals than Bank of America. Okay, we looked at JP Morgan, I think had something like revenue growth, 2 or 3% better than Bank of America. Profitability on a return on invested capital is upwards of 20% for JP Morgan, whereas it's closer to about 17 or 15% for Bank of America. So, just that marginal better performance by JP Morgan. But Bank of America stock trading for very much a value stock, right? Very much lower valuation. So you got to kind of make a decision there, whether you think there's going to be any kind of convergence in that valuation, whether Bank of America can raise its valuation, price to book valuation, whether it's future growth is there, or whether you're just willing to pay a little bit higher valuation price, right, for the better stock. For me personally, I'm willing to pay a little bit higher price to book or price to sales, whatever valuation measure you want to use. I'm willing to pay a little bit more for the stock that is the leader, has that competitive advantage, because I think that's going to mean that growth is higher in that stock. With JP Morgan, you're paying about a 1.5 times on a price to book value, whereas you only, I think it's like something like maybe 1.1 times price to book for Bank of America. But that growth is there for JP Morgan. The growth is faster, the profitability is faster, and I think that's going to provide the better returns for JP Morgan versus Bank of America. Now, Bank of America is still a great bank, still a very strong bank. They've got I think they're the 3rd largest deposit gatherer in the United States as far as banks. So they've got that cheap funding source, and anytime interest rates rise, bank stocks are going to do well. I think Wells Fargo analyst what's his name? Mike Mayo, very smart analyst, great analyst there, is talking about how bank profitability could be coming into a period, an era that is, better than any time since the 80s. Okay. And that is just, on these higher interest rates, as if short-term rates come down a little bit, we get a little bit steeper yield curve there. Banks are going to be making money hand over fist. Okay. They're going to be making lots of money on these longer-term mortgages, these longer-term loans, still paying nothing on their deposits rates. And making a lot of money. So I think Bank of America can do well. I also like Citigroup in the banks, but JP Morgan is really the undeniable leader in that space. Okay, portable. Yeah. So Canadian Hobbit does say, Generac generators aren't usually that portable, and they are not. We actually looked at generators when we moved here to Florida, and some of these things are monsters. Basically, you put them in your garage and they don't move, but they are great for when the power goes out. They can power your entire house. So you've got the huge ones for the most part, but then also the smaller ones that that are more or less portable. Okay, Udit wants to know about C3 AI. Talked about that earlier in the live stream. I do own shares, but I did cover them at $40 each on those covered calls because I think right now that C3 AI, that AI stock. Ticker AI, trading for about 10 times on a price to sales basis. It has come up 200% over just the last couple of weeks, and still doing very well, still coming up. But I'm a little worried about valuation at this point. I want to lock in some of those gains. I got about a 30% cash premium on the covered calls. I still have a 30% upside to $40. I think that's a great opportunity, to lock in some of the price there. How many shares of TDOC do you own? Teladoc, it would be about, I know I have about $60,000 in shares of Teladoc. It's at, what is it right now? It's about $31 a share right now, right? So it's about $30 a share. So 60, I guess that's, I want to say 30. There's about 2,000 shares. I think I have actually a little bit more. I think I have about 2,400 shares of Teladoc right now. And again, I've dollar cost averaged into those over the last year. Started buying in January of last year. Dollar cost average. I think my average cost for shares of Teladoc is around $35, $36. So still a little bit underwater in shares of Teladoc, but coming up pretty good. And again, that's one of my forever stocks. It's one of the stocks that I think can do really well over the next 10 years here. We are moving into a virtual healthcare environment. Yeah, you're still going to go see the doctor every once in a while, but there is a lot of things you can do virtually that are going to cut down the costs of healthcare and are going to make it just a little bit easier. And again, we're going with the companies that are leaders in the space, that really control that space. I think Teladoc is one of those, is the company for healthcare there, for virtual healthcare. And so yeah, I'm in the shares. I'm in for about 2,400 shares of Teladoc. What do you own these stocks? Plug Power, yeah. You can be a generator. Thank you. Open Door is comparable. Okay. Do you think Open Door is comparable to Carvana? That's interesting. So Ethan wants to know: do you think Open Door is comparable to Carvana? I mean, that's. I don't know. I really haven't touched either of those very closely. Obviously, Carvana jumping this year. Carvana really building off of last year's losses. You can see here it's up something like, I want to say something like 400% or something so far. It's down 6% today. But here, if you look at just the 1 year, 463 up to 13. So that's about 200-300% gain there. 200% gain on shares of Carvana just this year, really popping up. Open Door, obviously very much different segments. Open Door is the real estate, right? Real estate, whereas Carvana is cars. Open Door getting hit last year. I'm assuming, we've already seen 100% rise in shares of Open Door. I'm assuming you're kind of trying to think, okay, if Carvana went up 200-300% so far this year, then will Open Door do the same? I don't think you can really make a direct one-to-one comparison, just because the industry is so much different. I think with Open Door, you've got that downward trend in the real estate market, in the residential real estate market, has not hit its bottom yet. I think with Carvana, obviously with used car prices still very high, so I think there's probably still some weakness there. Interest rates, pricing out a lot of people out of cars. But I think the car market is probably further along in that sell-off than residential real estate. Okay, so I think the used car market, the car market probably bottom sooner than we see the residential real estate market bottom. So I think Open Door still has room to kind of sell off here a little bit, or have weakness in that market. But I mean, if you're looking at these two stocks, I mean, you really got to ask yourself, okay, do they have a competitive advantage in that segment, in that industry? Okay, and what I think you find is these. So for Carvana, this new distribution model for cars where people can buy a car online and just go pick it up at the Carvana or have it delivered. That is a really interesting, a really unique and innovative distribution model that is really beating the traditional way to go buy cars, right? If we had to buy 2 cars when we moved here to Florida. We had to get two used cars because I don't buy new cars because I'm too much of a cheap ass. But so we had to go out and you got to go to all the different lots. You got to look online, and it's just kind of a pain, right? It's going to take you a day or two just to really make sure you're getting the best deal. With something like a Carvana or something, it just makes the process so much easier. Get it delivered to you. They can deliver a car from miles away. So I mean, that's a really interesting and innovative concept that is going to be a competitive advantage for that. And I think they continue to take market share away from that traditional car buying market, right? So you look at something like that. Open Door, as far as real estate is always going to be local, right? You're not able to buy a house that is 100 miles away and have it shipped to you. Okay, so I think that kind of changes the dynamics of that market and of that distribution model. I think we've had the ability to look at a house online for decades now. So I don't think Open Door is nearly as innovative in residential real estate as Carvana is in cars. Okay, so just off a back of the envelope, real quick kind of thought process and analysis there. I mean, I think Carvana is much more the growth stock, the innovative company that's taking market share in its industry, rather than Open Door, which isn't quite as different from what you have with Zillow and with a lot of the traditional real estate market. Just a thought though. Do you say Zillow partnership with Open? No, I mean I really haven't followed Zillow or Open that closely, so I haven't really seen any kind of a partnership between the two, or really have anything on that. Call service crushes it. If you work healthcare, what's good percentage to buy in company is Centene? Okay. What else? What do you think of Hamilton Funds? Really don't know about Hamilton. Carvana is in real trouble. Open Door is ready to go bankrupt. Okay, so J. Paul saying both Carvana and Open Door are trouble, ready to go bankrupt. I mean, for a lot of these, especially the newer companies, the penny stocks, something we'll talk about in next week's penny stock video, you really got to watch that balance sheet. You really got to make sure that they have, the cash on hand to cover their short-term liabilities, things like that, the cash flow. You really got to follow that. Now, I wouldn't say just because a stock is down 75% that it's a bad stock. You cannot go just by what the stock has done in the past and kind of extrapolate that and say that that's a bad company. Okay, you really do have to follow the balance sheet, make sure that it has the balance sheet flexibility and the health to survive the current environment, the current economy. Okay. Then you can go from there and say, okay, what kind of a runway does this company has as far as survivability on that balance sheet? What's its cash burn? How much cash is it going through on its cash flow statement? Does it have 12 months or 2 years of cash to survive here for the market to rebound? You can't just say, a stock is down 75% and that therefore it must be a bad stock or a bad company, just because a lot of those growth stocks are down that much over the last year. That's just how the market is for a lot of those. So we've been here for about almost 2.5 hours. I'm gonna close up shop here. I got to get to the gym there. But if I didn't get your comment below, ask your question. I'll try to get to that as I'm at the gym sweating it out. But I appreciate it. Thank you everybody for being here. I love these back and forths in the Q&A and these live streams when we can get to it.